Is your paycheck silently shrinking even when your salary goes up? It's a feeling many of us know too well. Your money just doesn't stretch as far as it used to at the grocery store, gas station, or when paying bills. Today on the Capital Breakdown, we're unpacking a key culprit behind this squeeze: inflation. What exactly is inflation, and why does it make prices feel so high? By the end of this episode, you'll understand how inflation impacts your purchasing power, what drives it, and how to think about it in everyday life. This isn't about quick fixes or hype. It's about getting clear on what's really happening with your money so you can make smarter, calmer decisions. Many people think inflation is just about prices going up randomly or blame it on companies greedy for raising costs. But it's more complex than that. Inflation isn't just a number on a news ticker. It's the way your money's value changes over time. Imagine you have $100 today, and next year you want to buy the same basket of groceries. If prices rise by 5%, that same basket now costs $105. If your paycheck only grows by 3%, you effectively have less buying power even though you're earning more dollars. This disconnect is where a lot of confusion happens, and it's why people feel their cost of living is outpacing their income. So what exactly is inflation? Think of your money as a bucket of water. Over time, inflation is like tiny holes appearing at the bottom, letting water leak out slowly. That water is your purchasing power, the amount of stuff your money can buy. Inflation means prices for goods and services rise, so you need more dollars to fill the same bucket. Economists measure inflation by tracking the average price changes across a large basket of common goods and services like food, housing, and transportation. This basket is updated regularly to reflect what people actually spend on. When the overall cost of that basket rises, we say inflation is happening. Breaking it down, there are a few key terms to keep in mind. Purchasing power is how much you can buy with your money. Price level refers to the overall average of prices in the economy. An inflation rate is the percentage increase in price level over a certain period, usually a year. Imagine inflation as a rising river. If your boat, money, stays the same size but the river rises, prices, you need a bigger boat or you'll be underwater. That's why understanding inflation helps you see why simply getting a raise might not be enough to feel richer. Behind the scenes, inflation is influenced by many players and forces. Central banks, like the Federal Reserve, play a big role by controlling interest rates and the supply of money in the economy. When they lower interest rates or print more money, it can increase spending, pushing prices up. On the other side, producers and retailers adjust prices based on costs for raw materials, labor, and demand from consumers. Investors, fund managers, and brokers also react to inflation expectations, which can influence markets and borrowing costs. Money flows through this system with frictions like taxes, fees, and delays, all shaping how inflation ripples through daily life. For example, when central banks sense inflation is rising too fast, they might raise interest rates. This makes borrowing more expensive, cooling spending and price growth. But it's a delicate balance. Tighten too much, and economic growth slows down, possibly leading to job losses. On the flip side, if money supply grows too quickly, it fuels more demand than supply can meet, pushing prices higher. So inflation isn't just about prices climbing. It's a complex dance between money, supply, demand, and policy decisions that affects everything from your morning coffee to mortgage payments. Let's make it concrete. Imagine Sarah, who invests a fixed amount every month into a broad market index fund. Over time, her investment may grow, but if inflation runs higher than her returns, her real purchasing power, the money she can actually use, could be shrinking. On the emotional side, Sarah might feel frustrated seeing her account balance grow, but not keeping up with rising living costs. Now take Mike, who trades a single speculative stock, hoping for quick gains. The stock's price might jump or drop sharply, but inflation quietly eats away at the value of his gains if they don't outpace rising prices. Both scenarios show why understanding inflation matters, not just in numbers, but in how it shapes your financial experience. Both Sarah's and Mike's stories highlight important lessons. Investing is about time horizon and patience, not just chasing quick wins. Inflation can reduce real returns if you don't consider it. That's why diversification, spreading investments across many sectors and asset types, can help manage risk, and why keeping a long-term perspective is crucial. Quick trades or putting too much into one stock can expose you to volatility and losses. While inflation steadily erodes unprotected cash savings, understanding these dynamics helps you avoid common traps like panic selling or overconcentration that can hurt your financial progress. Where do people often get tripped up? One big pitfall is ignoring inflation's impact altogether and assuming a raise means more spending power. Another is chasing high-risk investments without recognizing the possibility of losing money, especially if you're using leverage or concentrated bets. Inflation also tends to hit fixed incomes hardest, so not adjusting your financial plan for rising costs can be costly. Patience and realistic expectations are your best defenses. Expect ups and downs, understand fees and taxes, and don't let short-term market noise cloud your long-term goals. It's also easy to overlook the role of emergency funds and budgeting in an inflationary world. Having cash set aside for unexpected expenses is critical because inflation can make prices jump suddenly, especially for essentials like fuel or food. Careful budgeting helps you identify where rising costs hit hardest and adjust accordingly. And when it comes to investing for retirement or other goals, factoring in inflation ensures you're not just growing your money nominally, but actually increasing your ability to spend in the future. This big-picture thinking helps you stay in control rather than reacting emotionally to price changes. So how should you think about inflation in your financial life? First, recognize it's a normal part of our economy, not a monster to fear, but a factor to manage. Building a diversified portfolio that includes assets historically known to keep pace with or exceed inflation, like broad market funds or real estate, can be a sensible approach. But remember, all investing carries risk, and past performance is not a guarantee of future results. Keep emergency savings liquid and review your budget regularly to stay ahead of rising costs. Finally, align your investment time horizon with your goals so you don't need to tap into funds during downturns or periods of high inflation. Inflation is a steady tide that changes the landscape of your money's value over time. Understanding it helps you avoid surprises and make calm, informed decisions. Keep your focus on time, diversification, and realistic expectations to maintain financial momentum. And always remember, no single strategy fits everyone. Do your own research, stay curious, and consider consulting a qualified financial professional to tailor your approach to your unique situation. To recap, inflation means rising prices that reduce your purchasing power over time, even if your paycheck grows. It's driven by complex economic forces, including central bank policies and supply-demand dynamics. The key to navigating inflation is understanding its impact on your money's value, staying diversified, and keeping a long-term perspective. This episode is for education only and not personalized financial advice. Thanks for breaking it down with us today on the Capital Breakdown. Keep learning, stay confident, and remember, your financial future is built one smart step at a time. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.